In recent months, growing speculation surrounding the potential revaluation of the Vietnamese dong has captured the attention of investors, economists, and global currency observers as Vietnam continues to position itself as one of Southeast Asia's fastest growing economies, driven by strong exports, foreign direct investment, and a rapidly expanding manufacturing base. Reports circulating in financial circles suggest that ongoing structural reforms, combined with macroeconomic stability, could influence the trajectory of the dong's exchange rate, although official confirmation from monetary authorities remains absent, and analysts caution against overinterpretation of speculative narratives. The Vietnamese dong, historically managed under a tightly controlled exchange rate regime, has long been considered a relatively stable currency compared to many emerging market counterparts, largely due to the prudent policies of the State Bank of Vietnam. Over the past decade, the central bank has maintained a managed float system, allowing gradual adjustments while preventing excessive volatility. This approach has helped Vietnam sustain export competitiveness, particularly in sectors such as electronics, textiles, and agriculture, where currency stability plays a critical role in maintaining pricing advantages in global markets. In recent trading sessions, the dong has demonstrated resilience against the US dollar, supported by consistent inflows of foreign investment and a strong trade surplus. Vietnam's export-oriented economy has benefited from global supply chain diversification as multinational corporations increasingly shift production away from China to alternative manufacturing hubs. This trend has strengthened the country's external position, contributing to a steady accumulation of foreign exchange reserves, which in turn provides the central bank with greater capacity to manage currency fluctuations. Despite these positive indicators, discussions around a sudden or dramatic revaluation of the Vietnamese dong remain largely speculative. Financial experts emphasize that any significant upward adjustment in the currency's value would need to be carefully balanced against potential risks to export competitiveness. A stronger dong could make Vietnamese goods more expensive in international markets, potentially reducing demand and affecting one of the country's primary engines of economic growth. As such, policymakers are expected to proceed cautiously, prioritizing gradual and controlled adjustments rather than abrupt changes. At the same time, inflation dynamics within Vietnam have remained relatively contained, providing additional flexibility for monetary authorities. Stable inflation, coupled with steady GDP growth, creates an environment in which the central bank can consider modest currency appreciation without triggering macroeconomic instability. However, global economic uncertainties, including fluctuating commodity prices and shifting interest rate policies in major economies, continue to pose external risks that could influence exchange rate decisions. Market participants have also pointed to Vietnam's improving financial infrastructure and regulatory framework as factors that could support long-term currency strengthening. Efforts to modernize the banking sector, enhance transparency, and attract higher quality foreign investment are seen as critical steps toward increasing confidence in the Vietnamese economy. As these reforms take hold, they may contribute to a gradual appreciation trend rather than a one-time revaluation event. Meanwhile, the role of remittances cannot be overlooked, as Vietnam remains one of the top recipients of overseas remittances in the region. These inflows provide a steady source of foreign currency, helping to stabilize the balance of payments and support the dong. Additionally, the country's participation in multiple free trade agreements has expanded its access to global markets, further strengthening its economic fundamentals. However, some analysts warn that expectations of a rapid revaluation are often fueled by misinformation or unrealistic comparisons with historical currency events in other countries. Unlike fixed exchange rate regimes that undergo sudden adjustments, Vietnam's managed float system is designed to avoid sharp disruptions. This means that any appreciation of the dong is more likely to occur gradually over time, reflecting underlying economic conditions rather than speculative triggers. From a policy perspective, the State Bank of Vietnam has consistently reiterated its commitment to maintaining exchange rate stability while supporting economic growth. Officials have indicated that the central bank will continue to monitor both domestic and international developments closely, adjusting its policies as needed to ensure macroeconomic balance. This cautious approach aligns with Vietnam's broader strategy of sustainable development, which prioritizes long-term stability over short-term gains. In the global context, the Vietnamese dong's performance must also be viewed in relation to broader currency trends. The strength of the US dollar, driven by monetary tightening in the United States, has placed pressure on many emerging market currencies. Despite this, the dong has managed to hold relatively steady, reflecting the resilience of Vietnam's economic fundamentals. This stability has enhanced investor confidence, further reinforcing the country's attractiveness as a destination for foreign capital. Looking ahead, the outlook for the Vietnamese dong will depend on a combination of domestic policy decisions and external economic conditions. Continued growth in exports, with sustained foreign investment and prudent monetary management, are expected to support the currency's stability. While gradual appreciation remains a possibility, the likelihood of a sudden revaluation event appears limited based on current evidence. Liquid financial analysts also highlight the importance of distinguishing between nominal exchange rate movements and real economic value. Even if the dong appreciates modestly against major currencies, its true strength will ultimately be determined by productivity gains, industrial development, and the overall competitiveness of the Vietnamese economy. In this sense, currency performance is both a reflection of and a contributor to broader economic progress. In conclusion, while the narrative of a Vietnamese dong revaluation continues to generate interest and speculation, the reality is more nuanced. Vietnam's economic trajectory remains positive, supported by strong fundamentals and effective policy management. However, any changes in the exchange rate are likely to be gradual and carefully calibrated rather than sudden or dramatic. Investors and observers are therefore advised to approach revaluation claims with caution, focusing instead on the underlying economic indicators that truly shape the currency's long-term direction.